Good evening and welcome to Mortgage Coffee Talk on Awaz Television in Canada and around the globe. Topic of tonight is barriers to getting a mortgage. As you know, there are more restriction on verifying the eligible income. There are tighter verification of standards and documentation. There is a greater scrutiny of credit reports. These are the few more improved challenges or new policies that are being implemented to ensure the creditors who are seeking mortgage financing are indeed eligible to qualify for a mortgage. In the past, mortgage income verification for the mortgage has not been as restricted. Now you have to make sure the income that you're claiming and putting in application is true income and is verifiable. Number two is that there are many tools now being used to verify the income that you have declared. And if you have challenges with your credit report, you will be now more vulnerable if you are not able to maintain your good credits. Because credit is very, very important, and your credit report reflects upon you how responsible you are. There are quite a few elements that pertains when you feel that there are barriers to arranging mortgage. Typically, we expect that the lender will be more flexible to give you the money when you buy a property. That is not the case. They need verification of your income, your asset, your credit reports, and your savings that you demonstrate. So what we're going to talk about is first of the rates. Question comes in, what kind of rate can I get in? The mortgage rate being offered to Canadians varies province by province because they are dependent on the ability of the person who's asking for the money. Yes, some has a better rates, some may not have it. But that determination is made on you when you submit an application for the mortgage. So you can see a variation in rate offering by lenders or by the credit unions, B lender, or by private. So it all depends on your circumstances. Is it a conventional mortgage or it is a refinancing? We're going to talk about that too. So they will be requiring a lot of verification. So rates are dependent of where you are located, which institution you have approached, which mortgage broker or agent is working with you, and how you qualify. So if you are in Ontario, in the province of Ontario, there are different rates. Every bank, every institution that lend money compete. So that means when you hire a broker or agent to help you, they will have their own source of lenders. B lenders, A lenders, which are banks, credit unions, and private financing. So, first of all, again, rate depends on where you locate it. So, second thing, more important that come along, it is a hold of a rate hold. When you are seeking a financing, you are trying to buy a home and you need to get pre-approved. So you will be asking a lender or bank to give you a period of time. They will lock in the rate for you. It depends, could be a 30 days, could be 45 days. Traditionally, we used to get 90 days, 120 days, but this all now depends on it, of your ability to secure a rate. So you need, if you are looking to purchase a home, to make sure that you apply for pre-approval and secure a rate for yourself, for your client, if you are a mortgage broker. Now, if you are arranging a mortgage, a first-time buyer, various different rules will apply, and there are some benefits. I think I talked about it in the last episode, where the government has a profit sharing financing. If you are a first time buyer and your income is not more than 120,000, you can qualify. If you buy a new house, you can get up to 10%. And if you buy a resale home, you can get up to 5% equity financing. So that will be a tool for new buyers. But when it comes to refinancing, I always suggest that if you are working with an existing bank, you continue with that bank because you have already established your relationship and you already have a credibility established with the bank, and you will continue with them and they would like to have your business. But if you are refinancing the business, then most important thing is that you may not get the better rate, because when you are refinancing is you are redoing a brand new mortgage. And if you are trying to go to another bank for a better deal, most likely if your income has declined, you may not be treated favorably as your existing lender who has been with you for last 2, 3, 5 years. Therefore, they will apply all the latest rules to you to qualify you. So the best thing would be for you to stay with the same lender that you are, unless you have absolutely no choice to do the refinancing. I recently have a refinancing question, a client that I refer to someone who is specialized in the equity financing. Because sometimes when you are a self-employed and you have equity in the house, the bank also look at your ability to pay the loan, monthly payment. So refinancing can be a challenge. So you make sure that you have considered that risk before you do the refinancing. Because when you are refinancing it, they will be treated as a brand new mortgage, and therefore you will be subject to all the new rules that apply. Now, let's assume you got a condo apartment or a typical property. You bought a condominium property, and then you need to get the financing. Even the cottage industries, Is this property is your for personal use, or are you using this as a as an investment? Some bank are now, especially the condo, lots of people have invested in the condos. Lots of banks are saying you cannot use equity from your line of credit to put the down payment. So you have to be very, very careful now if you are working on a condo or other units or larger finances to make sure that you are not putting yourself at a risk. This property, if your property is not your dwelling, full-time dwelling, then the rate will be different. Lots of people are declaring that this is my personal residence and they bought from the builder, but actually is an investment property. You may be subject to penalty from CRA if you have declared this is a principal residence, but then you applied and you rented the property. And those type of property, you will have a different interest rate if you are not using as a full-time dwelling for yourself. So how do you do the investment now? If you are planning to do investment, make sure you have a saving. And in order to have a saving, when you are applying for it, you have to demonstrate to the mortgage agent or broker that you have a saving, so that you will have a bank statement, you have a RRSP, you have a tax saving accounts, or shares or stock that you purchase for RRSP. Those are your source of deposit. So it's very, very important when you're declaring the property, it is for your personal use, because the bank will treat as an investment property as a high risk for lenders and investors. So you expect a high rate for that. So it's very, very critical for you to understand that the government programs are to help you to have your own home. And if you buy a second property that is not your prime residence, then you will be getting a higher interest rate. So it's very, very important for you to understand that. Do not misrepresent, do not tell a false information to the bank or to the mortgage broker, because it is punishable, is a crime. So if you declaring an income, that is your income. You will be able to support with your T4, T4As, or if you're a self-employed, you will have a T1 journal. It explains your income, gross income, and expenses. So everything that you present, for example, you bought a property, you're buying to buy property, you don't tell exact square footage of the house, because appraisal is going to do an appraisal to verify the size of the house. You don't exaggerate the price of the house to get financing. You cannot exaggerate the price and take a kickback from the seller as a part of a down payment. Down payment has to be verified. You must have the money in your bank account. How often and how seriously have you been doing it in the past? A lot of people are living in a luxurious home. They have no verified income, and they are living in a bigger home. What do you think about CRA? They're not going to find out. Where did you get the money to buy a multi-million-dollar house when you are declaring very small amount of income? So these are the challenges. Or you have an income that you don't declare. Be a responsible citizen, because it's very, very important that we have a system, already honest system, which has been jeopardized by people who are not following regulations. It's a criminal offense to submit false information to lenders, because you are asking the lender to give you the money that you need to buy a house for yourself or for investment. So again, make sure that when you are buying a property, you are declaring to the bank, mortgage broker, a lender, is it going to be your prime residence, or is going to be a not full dwelling? That means you may be renting a portion of it or full portion of it. If you're buying a home or a condominium from a builder, it has implication of declaration that when the builder is going to seek a rebate from CRA on your behalf. If you give a false declaration, CRA will come after you and they will charge you and penalize you. Anyone who is involved in trying to be fabricating or arranging documents that don't exist, showing income that doesn't exist, is punishable. You must be on their payroll. They will give you T4As or pay stubs. It's a proper income which is verifiable. Now, sometimes, because coronavirus has affected everybody's ability and people have lost a job, and your credit score may not be high enough. A credit score is a tool to determine your ability, and you're rated in a category that allows that you can, at certain level, you qualify for certain mortgage because you have demonstrated to be a responsible borrower. This is very, very important. But if your credit score is less, the real magic number is credit score is about 680. And you can qualify for the best mortgage rate if your score is 680. If you have high debt ratio and a smaller down payment, you will not get the best rate. They also need to track your record for 2 years to determine your rate score. So anytime you are buying and selling, either using a credit card, line of credit, mortgages that you have, they observe at least for 2 years how consistently you have been responsible making your payment on time. This is very, very important to check your credit every month or at least every 2, 3 months to make sure there is no irregularities in there. If you find an error in the report, you can approach Equifax and CRES TransUnion to correct that because it's going to impact your ability to get a loan. It's also going to affect your ability to get an amount that you want to meet your needs. So credit score is very critical. How often did you pull this report? It only costs maybe $10 or $15 or a little bit more. You can get that report and then you know. I remember many years ago when my son, who is a doctor now, I was trying to get a mortgage loan, student loan for him. I have to co-sign it. And my report came in somebody having a similar name, and TransUnion was pulling the report as my first and last name, and this gentleman with a similar name was causing problem. So bank knew about me, and they asked me, "We know about you, but if something is wrong, you might want to approach." I'm talking about 80 years ago. So I approached TransUnion. It took me 3, 4 months to correct everything. And I found out someone was either used my identity stolen or somebody was using, has a bad record. And because of his bad record, the system TransUnion have, it wasn't pulling my middle name. So I have to use my middle name to make sure I distinguish myself from them, but it still took many, many months to get this done. So you may not have any problem, but the credit report, if you don't check it with the similarity in name, can cause a harm to you. So therefore, it's very, very important that you pull out your report and check your credit report. The most important thing that comes to our mind next would be we want flexibility. We want no string attached. We want average payment, and we want lots of privilege. So we want flexibility in payments. We want the best rate. And then we want our ability to pay more toward principal on an annual basis. We want to double up our mortgage payment. And there are limitations because not every lender will let you pay more on a monthly basis, because the more you pay, the principal goes down. After you make the mortgage payment, and if you make a second payment, the entire amount goes to the principal. It increases your principal and decreases your interest payment. So we want flexibility, which is a good thing. That means you have created income, additional income, and you want to pay down your mortgage. But remember that historically mortgage has been low. If you owe money on a bank, a Visa, MasterCard, Home Depot card, other places, the interest rate is 11% to 22%, and I think the Home Depot has probably 28%. So your goal is to pay off those first. because your mortgage payment will eventually come down and you start contributing toward the principal. But the important thing is that you want to make sure that the highest interest payment that you are making, the highest, you are paying those interest first, because less you pay for the high interest and you paid off those, you will have more money available to pay for your mortgage. So we're going to talk about these issues about the mortgage. Your mortgage is not insured. Your mortgage is too big. Your income is too low. These are the challenges that we are facing now. So it's very, very important. If you have a total income within the family, gross income, and you have to create a budget and you look at them, how much we owe, which has the highest interest rate. When you are paying out a main payment toward a MasterCard, a Visa card, or a credit or anything, which is a higher interest rate than the mortgage, if you paid those out, you will have more money available to you to pay down your mortgage. Because mortgage period, depending on your situation, mostly people fix it a mortgage for 5 years. That's a very normal trend. Depending on your situation, if you are an investor, you want to flip the house, then it will be a different story. In a conventional way, a normal person buy a home and they live in there. I recommend that you live in your house for at least 10 years. Build your equity in the house. And if you are a starter home, or if you are trying to buy a home and you don't have the down payment, you can have a partnership with two people. See, having a home is a dream come true. So sometime, because prices goes up, you're not able to arrange financing. So sometime you can partner with two young friends, buy together, and one live in a basement, one live in upstairs. And after a few period of time, a couple of years down the line, when the equity of the house is built, one of you can buy the house, the other one go out and buy a new house, because then that time you have the money to buy it. But both will have equity in the house. It can be appraised at the time of disposition or separating partnership with your person who bought together with you. You can have a joint tenancy is only normally done in wife and husband, or is a common tenancy which a couple of friends can buy a property together, or family can join you to buy the property. So it's very, very important that it's good thing that you're thinking about getting a mortgage. Idea is that these are the barriers that we have to focus on to make sure that you overcome them. And my goal is to increase awareness, to educate you so you understand how the mortgage works and how you can work. In the mortgage business, you go to one bank. That bank will apply their own policies. There are 6, 7 banks. They all follow OFSI rules. Everybody follows them. And mortgage broker, when we are involved with the banks, we also follow them very strictly. But there are mortgage brokers and brokerages. They have alternate lenders, banks, credit unions, smaller banks, lenders, private lenders. Unfortunately, the rate interest will be different. If you're not going to A lender, which is the bank, and you go to B lender, you might have to pay the mortgage some fee, brokerage to arranging a mortgage. And solutions are there as long as you are able to provide accurate information to a mortgage agent or a broker that you qualify. Because false information can backfire not only you or the mortgage agent or a salesperson who's involved with arranging a mortgage and the mortgage brokerage. Because we abide by law. We are licensed. My license is MO800 2130. I'm licensed by FSRA, Financial Services Regulator Services Office. Brokerage is also licensed. So it's very, very important for us to follow the law, to make sure that we educate you, that you are prepared to get the mortgage. Now, we talk about flexibility. So you decide you want all the flexibility to get the best deal. Flexibility of payment, flexibility of lowest interest, minimum down payment. But make sure that you are maintaining your credit score. You are having a good income and you are not defaulting your payment, because it doesn't matter if it's a cell phone or telephone. If you don't pay a private lender, you go to the Best Buy and you don't pay, they're going to report you. It affects your credit score. So it's very, very important that we pay attention to these things. When you are buying a property, you are disclosing the true value of the property. A lot of people say, okay, can you exaggerate the price? And they sometimes talk. Private deals are done that where they exaggerated the price, they got the bank to give the money, and eventually when they did the appraisal, 6 months down the line again, the value was not there. So it's very, very important for you to make sure that you do not violate, misrepresent your information. Even though you think it's just a doing business, it's not. Everything is taken seriously. Whatever that you provide becomes part of the document to arrange a mortgage through a brokerage, through a mortgage broker or an agent, or through the lender. I hope that you are having some understanding. We're going to take a small break, and we will get back to you right after the break at Mortgage Coffee Talk. Thank you.
يا رمضان يا شهر الهدى يا شهر الندى يا شهر البركات يا رمضان.
Welcome back to Mortgage Coffee Talk on Awaz Entertainment, live in Canada and around the globe. We were talking about barriers of arranging a mortgage. We discussed quite a few items, and the next one is the mortgage that is not insured. When you seek a mortgage and your mortgage is over 20% more, the bank has to take the risk because CMHC only covers mortgages 20% and less. The risk of default is concerned to lenders and banks who are giving the money. They prefer that they have insurance coverage, that you put less than 20% down, their money is secured by CMHC. It's a federal institution. You pay a premium for that, and most of new home buyers who are putting down less than 20% are using CMHC because CMHC, as I mentioned earlier, will provide guaranteed for Canadians to have mortgage for the house. They started a equity sharing program where if you are buying a house and your income is 120,000 or less, and you buy a new home, they will give you 10% equity financing without any interest, and you put 10%, for example, for down payment, and you can get 10% from CMHC. And once you sell that house after 5 years, and if you make a profit of it, they will charge you 5% of the profit plus the money that you have equity sharing with them. They will take it back. So, example, if you bought a house for 400,000 and you took 10% is a builder home, so that means $40,000, and you put 10%, it's 40,000. Your mortgage is now 320. And after 5 years, you decided to sell the house, and your house value went 100,000. So you sold it at 500,000. So they will minus 400,000. So that means you made 100,000. They apply 10%. That means 10,000. So you will give back to the Canadian Mortgage Housing Corporation 50,000 because they share equity with you. They did not charge you interest at 40,000. Or if you buy a resale, it's 5,000, and they will charge 5%. And if the property value go down, they will minus that 5% or 10% from your final sale of the price. So you have to return money less. So it's a good program. In the meantime, the bank also guaranteed money by the CMHC. So if you are buying a bigger house, if you're buying a house or you're defaulting it for some reason, their risk is not covered unless it's CMHC. That's why they will do the appraisal to make sure the house is appraised well, and they will encourage you to have insurance because it provides them protection. Because in case of a default, they get paid. Bank don't take risk. It's us, human, citizen, borrower. We get the all the liabilities, responsibility. Because when we go to CMAC, we have to pay a premium. It's very high, depending on the category you are in. So now, and that is why sometimes the bank is very concerned, and this could be a barrier if you have some weaknesses in a certain area which bank may let it go, but as long as they are assured in case of your default, they will get their money. The other concern is at the same time is the mortgage is too big. Now that creates a lot of interesting conversation. When you are refinancing the mortgage, you want to get the maximum value of the property. Bank has restrictions. When you are buying a house, they want you to pay 25%. If you are a self-employed, like a real estate professional like I am, in order for me to qualify for mortgage, I have to pay 35% down payment to make them feel comfortable, because they will not have the insurance protection for CMAC. Therefore, they want me to pay 35%. As you know, especially the house is over $1 million, because it creates added risk for the bank. Bank is really taking a risk if they are dealing with a conventional mortgage which is higher than 20%. I tell you, let's assume the value of your house is $1.5 million. Let's assume that you have a good income, you have good credit, you have never defaulted, your property value is appraised equal to 1.5 million, and you want the flexibility and you take a $1.5 million mortgage financing. So you ask for the bank to give me the financing of 1.5 million purchase. Bank will give you first million, they give you 80%. So that means you will get 800,000, and they keep that 20% as a contingency in case you fail. Now the next 500,000, they only give you 50% financing. That means you will get a $1.1 million total financing for a purchase of $1.5 million home. So if you are putting a 35% down, so you have first 35, 350,000, then you have to do the another $500,000. So you are paying a very significant amount of money. So bank wants to make sure that are you willing to take risk with your own money? If you are, then bank will say, okay, I'll give you the money. So they might give you a mortgage that you need. They give you a home equity line. They give you a flexibility to use and draw money when you need it. But the threshold is the maximum that your property is a 1.5, the maximum they will give you is 1.1. So make sure that you understand that the bank, why they keep those extra money, because if fluctuation in value, the price, bank is assured the money that you took from them, they are still safe, because even if 5% value of the property declines in a specific period of time, then they are still protected and safe. And also, people don't understand sometimes when you take a mortgage and equity line, the bank will maximize the leverage against that mortgage. You may not be able to draw money or take alternate loan from other banks because they have maximized your mortgage. So this is very, very important for you to know that if you are working with a bank, you have a home equity line, you have a mortgage, the bank say your value of your property 1.5, they even though they give you 1.1 million, but they will take the whole 1.5 million. That means you cannot take a money from another lender against that house. And sometimes people will do it and bank will find out because someone you give you money, put a lien on the property or put a charge on the property, then the bank may withdraw the loan. They can call back the loan. That means you'll be in trouble. So before you ever apply for a loan or get a loan from anyone, make sure that you talk to your current because there is a first priority on the loan on the first home that you have. It's very, very critical for you to understand that. So make sure you do not go out and seek mortgage from other people where you already committed and a bank has taken the full amount and appraised value of your property. The lost income is too low. You know, when you ask for the mortgage, and especially for the self-employed, lender expects you, if you're self-employed, they might want you to pay maybe 35, 45% when they're taking mortgage. Because on less income is a level of uncomfort for the lender. Because you're not demonstrating that you have the ability to pay your mortgage. So how can you do it? So they have to look at your worthwhile for 2 years. See what have you been doing for the last 2 years and what kind of income you have. And they will do an average of 2 years income to come up with the average per year price in income. So it's very important that you will have to do a big payment. If your income is low, you have to pay a big payment, down payment when you're buying a property. It's very, very critical. So mostly bank will want to pay out all the debt. So what bank will tell you that all the big card, MasterCard, whatever the card you have, they want you to pay out that. So there's enough money left for you to pay the mortgage and you don't default. They are doing their job. Purpose is not to get you in trouble by owning a property. Idea is that you will enjoy a property, you get your mortgage in a way that you are living and enjoying the house that you bought for your family and have a fun, enjoyable time. Take care of your children because home is a place where our joy of our life begins and end at home. So it's the best thing you can do is to buy a home. But it's very, very prudent for you to check to make sure that you are increasing your income. Make sure you have verifiable income. You have a good credit report and you can have a good saving. So I hope today's barriers that we discuss about the mortgage are helpful to you. I take this opportunity to thank our doctors, health specialists, nurses, paramedic, police who have put their life or putting their life online to protect fellow citizens and to avoid the spread of coronavirus. As The government of Ontario and federal government is easing on coronavirus and opening businesses. We still need to demonstrate responsibility to keeping social distance, avoid unnecessary visit from out of the house, continue to do remotely work that we want to do, but make sure that this virus is totally eliminated and we are safe and enjoy our life. On behalf of Awaz Entertainment and Mortgage Coffee Talk, we thank you all. May God bless you safe. May God bless you all. May God bless Canada. Thank you very much for watching. Bye for now. Good night.